Yes, good morning. Good morning. Can you hear me now? Can you hear me now? Hello. Hello. Can you hear me? Hello.
Hello?
You can hear me now?
Yes.
Very good. I'm happy we were able to fix that problem.
Oh, yeah, okay.
Okay, so welcome to session 2. This is, I think, your second day, and I wanted us to see what we have on our outline so that we can carry on from there.
Okay.
Yeah, what we have on our outline is we covered trend analysis yesterday. Do you have any questions coming out of what we covered yesterday?
Okay, my only question that I had was when you are doing the hello?
Yes, I can hear you.
Oh, when you are doing the high lows and the high lows and the high highs,
Yes.
which is the best time frame for you to be able to see them clearly?
Which is the best
Time frame.
time frame?
Mm.
No, the concept of higher highs and higher lows is a price action concept. It doesn't care about your time frame. You can use it on any time frame.
Oh, okay, okay.
Actually, anything we are learning in this course is pure price action, and the price action can be used on any time frame. So you learn the concept and use the daily chart, 5-minute chart. It's up to you.
Okay.
Yes.
Then I become fine.
All right, because now just to confirm to you, this is a 1-hour chart. You can see prices going up, comes down, goes up, comes down, goes up, comes down. If you go back to 15 minutes chart, the same concept starts here, goes up, comes down, goes up, comes down, goes up, comes down. Go to 1 minute, same policy, up, down, up, down, up, down. It doesn't matter. Even the daily chart will have the same features, up, down, up, down, up, down, up, down, up, down, just like that.
Okay.
Yes. So today, I think I want us to talk about something important. Maybe we can just follow the way our outline is. Our outline says today we talk about candlestick patterns. Number 3.
Yeah.
Now,
3.
I may have mentioned this before that, or I may not have mentioned, but the 3 things that must be there for you to trade, to enter trade, the 3 things minimum. The minimum things you must have for you to enter trade is number 1, you must ensure you have a trend. That is when you start trading. You must ensure you have a trend. And what you need to do is to follow the trend. If the trend is uptrend, you buy. You look for a signal to buy. If the trend is down, you are looking for a signal to sell. Remember, when you are buying, you are anticipating that price will continue going up. That's how you make profits. When you are selling, you are anticipating that price will go down, and that's how you make profits. So only trade when there is a clear trend. And I was able to share with you ways of determining the trend using the higher highs Just remember that in an uptrend, we will always have higher highs forming together with higher lows. Okay? And that is what we were saying. We make a high, a higher low, a higher high, a higher low, a higher high, a higher low, a higher high. When you see market moving in this manner, upwards, sloping upwards, that's clearly an uptrend. And you can see something like that. We start from here, we make a high, a low, a higher high, a higher low, a higher high, a higher. This is an uptrend. So at concept number one, trend. Concept number two, you must have support and resistance. This is what I call levels. You must have levels on your chart. Now I'm telling you the three most important things you must have for a signal. So you must have levels, support and resistance. We'll talk about support and resistance tomorrow. Now you must support and resistance, the things you are seeing on the chart. This line, this line, this line here, this line here, that line there. Levels on the market, levels on your chart where the market is changing direction. Like now the market was going up, changes direction from here, that becomes a resistance. When it's going down and finds a level and stops going down, that becomes a support. So resistance, support, resistance, support, resistance, support, resistance, support. Then number three that you need on your chart for a signal to be at least useful to you, you need candlestick signals. You need a signal, and in most cases, our signals will come from candlestick patterns. So once we cover today's session and we cover tomorrow's session, you should be able to start seeing how you can start placing trades easily without too much struggle. So the rest of the topics will just help you understand more about the three concepts. Because again, they will give you strategies to follow, and you will be able to benefit from the same. So today, let's do candlestick patterns. Today, God willing, support and resistance. And I will combine chapter 4 and chapter 5 together, because together, these things are used to support and resistance. This and this and this. They give you levels on the market where you can buy or sell. Right, so let's look at candlestick patterns. Candlestick patterns come in many ways. I've given you an ebook. I shared with you an ebook. Now, this ebook outlines 9 profitable candlestick patterns every trader must know or should know. Now, why do we need these candlestick patterns? Because candlestick patterns give us signals. They tell us whether it's okay to buy or it's okay to sell. They tell us whether it's okay to close a trade early or to let the trade continue running. So you cannot really survive the Forex market without understanding candlestick patterns and what they mean. Candlestick patterns and what they mean. Each candlestick on the chart is a pattern. Or it could be one candlestick, it could be 2 candlesticks, it could be 3, 4 candlesticks combined together. They give you a pattern that repeatedly has been studied and has been found to be communicating a certain message. So I want us to look at those candlestick patterns and what they are saying to us on the chart. Now, the candlestick patterns can be used for 2 things. Candlestick patterns can be used for 2 main reasons, 2 main purposes. Number one, a candlestick can be used to indicate a reversal. The candlestick pattern can tell you that the market is going to change direction. That's when we say reversal. Okay? If the market is going down and you meet a certain candlestick pattern, that candlestick pattern will be telling you now we are not going to continue down, instead we start going up. Or the market has been going up and you meet a certain candlestick pattern here, it will tell you that the market is now going to change direction and go down. That's the meaning of a reversal. It changes the trend or the direction of the market from up to down or from down to up. Now, some candlestick patterns can also be used for continuation. Continuation. Okay? So these are candlestick patterns you will find if you are in an uptrend already. You'll find the pattern here and it tells you continue going up. Or you are in a downtrend and you'll find the pattern somewhere here and it says just continue going down. So those are the two categories of candlestick patterns. One tells you continue, one tells you change direction, the other one tells you continue. Now do remember that one candlestick pattern can tell you both, depending on where you find it on the chart. If you find a pattern, if you find a continuation pattern at support and resistance, it might actually be a reversal pattern. So we'll be able to see them. But for now, let's just get to see all the candlestick patterns and what they mean on the charts. So head over here so that we don't waste too much time drawing. Now, if you look at what we have here, we have a doji candlestick pattern. Doji, these are Japanese words. Now, a doji means price opened and closed at the same point. Price opened, so look at that. When you see a pattern like this, now remember, for every candlestick, we have many things to learn. Let me just zoom my chart a little bit. Let's pick a candlestick, any candlestick from here. Let's pick this large one here. You can see that. Now, this candlestick has 4 parts, 4 levels. The bottom one, this is the low price. The top one, that is the high price. For a green candle, this is where the candle started from. This is the open price, down here, where the body starts. Then where the body closed, that is the closing price. So when maybe you start reading books, you start seeing things like there is low, there is open, there is close, there is high. So you're likely to see a concept like this, low, core, whatever order it's placed in. So you will always get the low, the open, the close, the high for a green candle. For a red candle, the story could be different. Like now for this red candle, this is still the high. The high is always just the normal high. The lowest value is still the low. But for a red candle, it opened above there and closed down here. So this is the close. I believe those concepts are not foreign to you. You are at least aware of them.
Yeah.
Great. Now, with that, if you see a candlestick pattern that looks like that, at least you know this is the low. You can see this is the high. But now we don't have the open and the close. They are here together. So in this case, the open is also equal to the close. That's a doji. Where it opened is where it closed.
And the open and the close has to be at the center.
Yes. You know, the candle opened here, tried to go down, failed to sustain the price, tried to go up, failed to sustain the price, came back to where it started. So assume someone is, assume you're selling something at 100 shillings or $100. So you open, maybe you're in a market and you say the price is 100. Then people start buying, you increase it to 110, maybe people stop buying, you go down to 95, more people buy, but then they stop again, you go back to 100. In other words, remember for our chart here, this is a daily chart. Each candle is a day, so this is a full day. So in our case, if we are considering this one as a daily candle, it means at the start of the day, the price was here. But in the course of the day, before the day ended, price might have gone up to that level, could not stay there, then tried to go down, could not stay there, decided to come back to where it started, and the day ended there. That is the meaning of a doji. Now, this kind of a doji simply says indecision. Indecision. Market's not decided. Because if you look at where the line is, here, down here, when the market was pushing down, who are these who are pushing the market down? Bears. The bears were trying to sell. People were trying to sell, but they could not continue selling down. Buyers said, no, we cannot allow low prices. The buyers started pushing the market up. At that point, the buyers could not continue going up. The seller said, no, we don't allow this price. They pushed the price down. So here is a case where buyers are equal to sellers. The force is the same. So all dojis behave the same, but they communicate slightly something different. So if you check what we have on our in our ebook here, a doji could look like this. A doji could look like any of these that you are seeing here, like that. That's the one I drew, okay? Pure indecision, where it opened and closed at the same level, but tried to go up, failed, tried to go down, failed. We sure don't know whether it started by going down and failed, then went up, or it started by up, then went down. All we know is it was not able to go up and stay there. It was not able to go down and stay there. It opted to close at the same level. Now, this is a sign of like tug of war. One side is pulling, the other side is pulling, and they stop moving because the strength is the same. So whenever you see this kind of a candle, you need to see where it is located. If it is at a support or a resistance level, the market is likely to change direction. But if you find it somewhere there is no support or resistance, the market will continue going.
It will continue.
The market will continue.
Okay.
First understand, I'll show you. And then we have this. This is also a doji. The horizontal line you see down there is the open, is the close, is the low. Market opened here, tried to go up, it created a high, came back to where it opened and closed there. Now, where it opened, where it closed is also the low price. This one. We call it, as you can see down here, gravestone doji. This is just a doji. This is a gravestone doji. It looks like a gravestone. What you might find that these are the things you find in cemeteries. The word grave, yes. Now, the opposite is this, called a dragonfly doji. It's the inverted version of this. In other words, price opened at the top here, tried to go down and failed, came back to where it opened and closed there. Now, apparently, the opening price is equal to the closing price and is equal to the high price. So we have three things at the top. Now, the psychology behind this candle is there's a lot of pressure from down. There's a lot of pressure from buyers. That's why when sellers tried to go down, buyers came back and said, no, 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 no. They pushed price up. This one is called a long-legged doji. Long-legged doji. It's slightly different from this in that this one looks like a plus. But this one, there is a long wick at the top and a long wick at the bottom. So it's the same concept as this indecision. Sellers tried to push the market down, failed. Buyers tried to push the market up and failed. The price closed where it opened. But this time we have a high, we have a low. So all these kind of patterns you are seeing on your chart qualify to be called dojis. These are doji, 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 doji. And they all say indecision, depending on where you can find them. You can trade them as continuation signals, or you can trade them as reversal signals. I'll show you that as we move on. So that is, let's go to the chart and see these candles. Maybe I go to 1 hour chart, because I would like you to start identifying them. So what I can do is let me change a color here that I can easily spot them. Let me make them blue. I can see them very quickly. Here is one. Can you see that? Here is a doji. Long-legged doji, this one.
Yeah, long-legged.
There is another one. This is a doji, the first one we saw. Long-legged doji again. Gravestone, almost a gravestone doji kind of. Another kind of gravestone doji. Gravestone doji here again. No more doji. This is almost like a dragonfly doji, this one. They are all dojis generally, just know them as dojis. Long-legged dojis sometimes look like the other patterns. The dojis are everywhere. Price opened here and closed here, but tried to go up, tried to go down, and failed. All right, so when we move on to the second candlestick pattern, that's number one. Number two is engulfing. Engulfing candlestick pattern. The word is here, engulfing candlestick pattern. Engulfing. To engulf is like to cover completely. To cover completely, okay? So engulfing looks like this, where we have a small red candle followed by a very big green candle that covers the body of the previous candle. You can see the green is covering the body of the red. You can also see this is now a bullish. A is bullish because remember, green candles are bullish candles. Red candles are bearish candles. So when you see a green candle has covered a red candle, that becomes a bullish engulfing. But if the green has been covered by a red, it's bearish engulfing. The logic here is this was the strength of buyers. Let me just those are the sellers, and these are the buyers. Clearly, it means sellers tried to move the market down, but buyers came in and consumed, like they overpowered the sellers completely. Because you can see a larger green candle, meaning buyers were stronger than the previous sellers. So this is a signal that says the market is likely to continue going up. If you see this pattern on the chart, the market is likely to continue going up. If you see this pattern on the chart, the market is likely to continue down. Why? Already by this large red candle, covering the previous small green candle means the bears are very strong. And because they are very strong, they are likely to continue moving the market down. Because the work of bears is to continue moving the market down. The work of bulls is to continue moving the market up. So over to the chart. As a matter of fact, this pattern is very important, and I will give you one strategy called the engulfing strategy. One of the strategies I will teach you is based on this candlestick pattern. So take it seriously so that you get to see it in action. So let's go to the charts and see, spot some of these. Do you see one here? Small red, larger green. Do you see that the market went up actually after that? Are we there?
Yeah.
This is bullish engulfing. The green candle closes above the red.
It covered it completely.
Yeah, the body of the green covers the body of the red, and the closes above it. That's bullish engulfing. Let me show you more patterns. They are there on the chart. Another bullish engulfing, you can see it here. A small red body, bigger green body, which covers the red. It closes above. That's what we mean engulfing. It closes above the red candle.
Yeah.
So bullish engulfing, and the market went up. Bullish engulfing, market did not go up. It's not in all cases that it will go up. Bullish engulfing, market goes up. Bullish engulfing here, market goes up. Bullish engulfing here, this green is bigger than this red, market goes up. Bullish engulfing here, market fails to go up. Bullish engulfing doesn't go up much. Bullish engulfing doesn't go up at all. Bullish engulfing, not much. Bullish engulfing, not much. Now let's see bearish engulfing. Bearish engulfing is here, market goes down. Bearish engulfing is here, market goes down. Bearish engulfing, down. Bearish engulfing, down. Bearish engulfing, market goes down. You can now spot them very quickly, right? Very good. So when you see this candlestick pattern at specific levels, once we cover support and resistance, you start understanding these things clearly. So mark that candlestick pattern. It's very important. We head over to the next candlestick pattern. It's called Harami. Harami. Now, the Harami candlestick pattern is also called the inside bar. Inside bar. Now, this is inside. It's called an inside bar. Inside bar. So that's what we call the Harami, inside bar. And sometimes it's also called mother and son. Mother and son. It's called mother and son. Mama na mtoto wake. It's called mother and son, and you will get to understand. Now look at this pattern here. We have it's the opposite of engulfing, opposite of engulfing. Now we have a large red candle here, followed by a small green candle, which is right inside the previous body. The body of this second candle is small and is inside the previous body. Now, we always use the last candle to determine whether it's bullish or bearish. The second candle here is green, so this is bullish harami. That is bullish harami. If you see a large green candle followed by a small red candle, and the red candle is inside the body of the previous green candle, that is bearish harami or bearish inside bar. Bearish inside bar, bullish inside bar. Bearish harami, bullish harami. Bearish mother and son, bullish mother and son. It's you to choose the name that you feel comfortable with. Now, what this pattern is saying is simple. This one is saying that even though the sellers were very strong, they could not continue going down. Instead, buyers have tried to come back. Buyers have come back to the market. Now, the other one is saying, even though sellers were very strong from candle 1, sellers came back in candle 2. And so the market is likely to go down when you see this. The market is likely to go up when you see this. So bullish harami will move the market up. Bearish harami will move the market down. That's the message you see on these candlesticks. So let's head over to the chart and see the candlestick, those patterns we are talking about. They are there. Look at this. The body is right inside the previous body, and even the wicks. So that says the market is likely to go down. Okay, let me see if we can get another one. There are many. You just need to spot them and trade them the way you find them. Just ensure that the second candle is always smaller than the first candle, and the body is also inside the previous candle. This cannot be an inside bar. This cannot be an inside bar because this candle, the tail is above the previous. So the whole thing should be inside the candle.
The wick and the body.
Yes, should be inside the previous candle. So let's see examples. Here is one, bearish harami.
Oh, yeah.
All right. Let's see bullish haramis. And then you can find time to study the chart and see those patterns. So that now the next one would be, just a moment. So let's see bullish ones. A bullish harami, I want to see one. There's a bullish harami here. Some other textbooks will tell you that the body and the wick must be inside the body. But I believe if the body is inside the body and the tail and the tail are still inside the entire candle, that's fine. Okay, what more? I think that's fine. You can find examples in books later or on your chart. So maybe you pick a different time frame, you'll see some of those patterns. And we'll have a strategy on this inside bar. There'll be a strategy on the inside bar. So you better get to understand how to identify. Let's identify one more bullish pattern. One more bullish pattern, and we end it there. There is one here. The body is right inside the body, but even the wicks are inside the whole candle. So that will be a bullish harami in my understanding. Now, we have another pattern here. The other pattern we have is dark cloud cover. We have dark cloud cover, and we have a piercing pattern. Dark cloud cover looks like this. We have a green candle, followed by a red candle, but the red candle opens above the green candle. You can see? Look at that carefully. This candle closed, the green candle closed here. But instead of the red candle opening here and moving down, it jumped up and opened from here. So there's a gap.
Oh, okay.
So it gaps up, opens above there, and closes below 50% of the previous green candle.
Okay.
So the logic is, we have a green candle followed by a red candle, and the red candle must close below the 50%, half of the green candle. Half of the green candle. Assume that is the 50% level. We are looking at the body from here to here. Half of it is around here. Okay? So the red candle must close below the 50% mark. But remember, it should not close below the green candle. Because if it closes below the green candle, it becomes bearish engulfing. So it closes below the middle of the green candle, but above the open of the green candle. So inside here. Now the opposite, so this is a dark cloud cover, and the signal is the market is likely to go down.
To go down.
Yes, the last candle is red, so the market is likely to go down. The opposite of that is a candle that we call piercing line. Piercing line is here. Is quite the opposite. We have a red candle. You can see we have a red candle here, followed by a green candle, and the green candle closes above the midpoint of the red candle. Assume this is the half of the candle. So it closes above the midpoint, but not above the body. So we call it a piercing line. So the piercing line says the market is likely to go up. The last candle is green. So this is a bullish signal. A dark cloud cover is a bearish signal. So bullish, the previous one is bearish. So let's identify them on the chart quickly on maybe 1 hour. So here is one. This candle closed above the half of the red, but not above the body. Piercing line. Piercing line. This green candle closed above the midpoint of the red candle, but not above the body. Piercing line. Okay. Remember, this is bearish engulfing, bearish engulfing. Another piercing line is here. The green candle did not close above the body, but above the half. Another piercing line is here. Okay. Technically, you expect that for a piercing pattern, the second candle opens slightly below. I'm trying to zoom the chart. If you look at where the red candle closed and where the green candle closed, it's expected that the green candle will jump down, then go up. But that does not always happen. That does not always happen. So sometimes you read textbooks, they will say that's what you need to see, these gaps. Closed, gaps up, and then comes down. For piercing line, it jumps down and then goes up. So there's a difference. There's a gap. So, but let's try to see setups like those. 2 more examples, and then we go to another pattern because there are many patterns. Here is one. Okay.
Yeah.
This is a dark cloud cover. The red close below the half of the green. And then a piercing line. Just need a piercing line and we end it there for now. Here is a piercing line. We look at it. The green candle was able to close above the half of the red candle. Okay, so leave it at that. So that's the pattern. And like I've told you already, when you see this one, it says the market is likely to go up. When you see this one, it says the market is likely to go down. The last candle is important. The last candle tells you what the market intends to go. Let's go to the shooting star. Shooting star is a candle like you can see, the body and a long wick at the top. It's like shooting to the stars, shooting to the sky. And the meaning is, the logic is, market opened here, traveled all that distance to that level, but was not able to close here, instead came down and closed here. If you look at the wick is around 2 times the body. The wick is around double the size of the body. That's what we call a shooting star. It means the market is saying we are likely to go down now because there's too much pressure from the top. The wick means pressure. The buyers tried to go up. There was too much pressure from sellers or the bears. They pushed the market to close lower. So these are bearish signals. It says the market is likely to go down. So the opposite of this is what we call a hammer. Let me give you, okay, that is, the hammer is here. The opposite. This one is like shooting to the ground. So in essence here, the market opens here. The market opened here. Tried to go down all that distance, but could not. There was too much pressure from down here. Whose pressure is this? Buyers. You know, buyers are the ones who push the market up. So there was too much pressure from buyers that the candle ended up closing above. And if you look at this wick, the distance for the wick compared to the body, you will notice the wick is almost twice the body. Meaning, this is a bullish signal. The market is likely to go up. The market is likely to go up. So let's identify these ones on the chart very quickly. Very quickly. And there will be a strategy based on this candlestick pattern also. One of the strategies I'll be able to share with you. So look at the chart. And you start seeing setups easily. Look at this pattern, shooting star. The color is not important, by the way. The color can be green or red. There's a long wick at the top. Now, I don't like this as a shooting star, but let me give you a clear shooting star, this one. Small body, long wick at the top. Market goes down, as you can see. Let's move on. Market is going up and finds this a shooting star. This is another shooting star. After that, the market goes down. There's another shooting star here. You find a shooting star if the market was going up. Maybe I need to say that clearly. You will find a shooting star in an uptrend. If the market is going up like that, and you find a candlestick pattern like this, if you find a candlestick pattern that looks like this, and the market was trending up, that's a shooting star. A shooting star can only be found in an uptrend, like this. So market must be moving up before forming this candle. That's when it becomes a shooting star. They have other names if they are found in a downtrend. So let's identify that. The same way, if the market was going down, like this, that's now when you expect to find, that's when you expect to find this pattern called a hammer, or the equivalent to green, which is also a hammer, like this. So these are called hammers, the opposite of a shooting star. So you find this in a downtrend, they are called hammers. Okay? All right, so let's identify them on the charts. The two patterns. We have seen this as shooting star because the market was going up before, shooting star. If the market was going down and you find the hammer, then that can be called a hammer. So the market's now moving down, this is a hammer. Market's going up, shooting star. They are very common on the chart. You will see them frequently. Market's moving up, shooting star. Market has been moving down, hammer. Are we there?
Yeah.
The color is not important. Now, there's something very interesting also about these patterns, and you need to be aware of them. Now, we already said, if you are going up, if the market was trending up, and you find a candlestick pattern that looks like this. If you find this, where the market is going up, we say that's a shooting star, correct? If you found the same, but with a different color, that is still a shooting star, correct? This shooting star is also called a bearish pin bar. Bearish pin bar. Pin bar. The two of them, these two, can also be called bearish pin bar. Bearish because they are communicating that the market is likely to go down, bearish, to become bearish. Now, interestingly, so for now, just call them shooting star, all right? But what if you found the same shooting star in a downtrend? Market's going down, and now you find the same thing. But now remember, the market's going in a downtrend. So if these are called shooting stars, in a downtrend, these ones are called inverted hammers.
Inverted hammer?
Inverted hammer, yes. Inverted hammer. If you find them in a downtrend, when the market was moving down, they become inverted hammer. Now remember, a hammer looks like this. So an inverted hammer would be the exact opposite. The wick now is at the top. So this is an inverted hammer. Now, in other words, when the market is trending up like this, and you find this, it's a shooting star. If you find this, it's called a hanging man. Hanging man. Hanging, just to hang, like to hang from a tree. Hanging man. So just understand the flow. In an uptrend, if you find this, whether it's green or red, it is called a shooting star. It's also called a bearish pin bar. But if you find a hammer in an uptrend, that hammer is called hanging man. Now, if we are going down and we find this candle, whether green or red, it's called a hammer. But if you find the opposite, it is called inverted hammer. Are we there?
Yeah.
Very good. Now, whether you find this one or you find this one, it says the market now is going to go up. And if you are going up and you found this, or you found this, it says the market is going to go down. It may not be immediately, but if you check carefully, you see that the market changes direction after those candlesticks have been printed on the chart. So let's scan for all of them. You just need to know when you found the pattern, was the market moving up or down? Market is going up. This is a shooting star, correct? But what kind of candle is this? Hanging man now. It's a hammer. So I don't know whether I can find it. I can show you when it's taking double rolls. Look at this. When we are moving down, this red candle is a hammer. But now when we are going up, we will find it, it's called a hanging man. This is the same as this.
Yeah.
In a downtrend, it's called a hammer. In an uptrend, it's called a hanging man. So when you find it in a downtrend, it says the market will go up. If you find it in an uptrend, it says the market will go down. So it's based on where you find it. There's another hanging man here, you can see. Market has been going up. Then some kind of a shooting star. Okay, let's see. There will be a strategy on those candlestick patterns, so get used to them in advance. There's a hammer here. Hanging man. I want to show you an inverted hammer. An inverted hammer will be found in a downtrend when the market is going down. This is a hammer. An inverted hammer is here. Okay. So whether it's inverted hammer or hammer, if you find it in a downtrend, it says the market is likely to go up.
Yeah.
Because it says buyers tried to go up, they were rejected by sellers.
Yeah.
But that means buyers are here because the market has been going down. All right, so then we move on to another set of candlestick patterns. Hanging man, we have covered that. Yeah. The other one is called hanging man. We covered that. Spinning top and spinning bottom. Now, a spinning top or a spinning bottom would look like this. This is a spinning top if you find it in an uptrend. This is a spinning top if you find it in an uptrend. In other words, we have a small body with the wicks that are almost equal. The upper wick and the lower wick are almost equal in size.
Mm-hmm.
The same with the red candle. So the color is not important. But in short, if you find a candle like a pattern like this in an uptrend, that's called a spinning top. If you find a pattern like this in a downtrend, it's called a spinning bottom.
Mm-hmm.
Many textbooks will not tell you it's a spinning bottom, but actually it's a spinning bottom when you're going down. When you're going up, you find the end of this, it's a spinning top. They both say the same thing. If market's going up and you find this, say the market is likely to go down. If you market is going up, down, and you find any of these two, it says the market might reverse and go up. So let's see them. Just remember, the body is slightly small. The wicks are almost the same in size. Here is one.
Mm-hmm.
Market has been going up. Here is one. Market goes down. Market is going where? Now let's see another one. Something similar to that. Spinning top, market goes down. Spinning bottom, here, market has been going down. Spinning bottom, market goes up. Spinning top, spinning bottom in a downtrend, market goes up. Spinning top, market goes down. So you just need to see that there's a body and the wicks are almost the same. That's the logic. The next candlestick pattern, which is also very important, is which one? Oh, we have finished. Okay, I think we have finished those. Those are the 9 candlestick patterns we talk about most frequently. There is one I needed to mention because you'll come across it. There is one called Marubozu. Marubozu, Japanese name.
Marubozu.
Is a Marubozu. Marubozu. Sometimes this name, this O is a U, Marubozu. So it could be a Marubozu or a Marubozu, like this. And a Marubozu candlestick pattern is interesting in the sense that it's a candle that looks like that. There is no wick at the top, there's no wick at the bottom.
It has no wick.
So there are 3 versions. For a bearish one, this one, for a red candle, you can find this. There's no wick at the top, no wick at the bottom. Or you can find this, a wick at the bottom only. Or you can find this, a wick at the top only. Whichever the case, there must be one side without a wick. Okay? In other words, this candle opened here, did not even try to go up. It just opened and immediately went down. Never tried to make a high. So in this case, the open is the high. The open equals the high. For this candle, the open is the high, the close is the low. They're the same. For this one, there is a high, there is an open, and there's a close. The close is also the low. Now, correspondingly, we might have green candles. So we can also have a Marubozu that looks like that. There's no wick at the top, no wick. So it opened here, went up, closed here. There's no high, there's no low. In this case, the high and the close is the same. The open and the close is the same. Or you can have this with a tail on that side, or you can have this with a tail on this side. These are Marubozus. Now, here is one. Can you see that? There's no wick at the top for this candle. There's no wick at the top. There's no wick at the top. No wick at the bottom. Okay? No wick at the top. So those are Marubozu candlestick patterns anyway. All right? So, let me see.
Have you seen what they mean?
Have I?
What is, if you made cash?
Have I?
Have you seen what is the trade?
I'm not hearing you.
What trade do they show?
Oh, the trend they show?
Yeah.
Now, Amarubozu will communicate different things depending on where you find it. Huh? For example, when you find this kind of candle, it means the bulls are very strong. The market's likely to continue going up. The market's likely to continue going up because it closed here without rejection. There's no wick. When there's no wick, it means when there's no wick here, means sellers were not rejecting their price, so the market's likely to continue in the same direction. If you found a red one, if you found a red candle that looks like that, it might have a wick at the top. It means it closed here without rejection, meaning the market is likely to continue going down. That's the logic behind it. But again, it will depend on where you will find this pattern on the chart. Okay, so that is it for candlestick patterns. There are strategies based on those candlestick patterns, but it becomes very important now when we start talking about support and resistance. Then you start seeing how to trade those candlestick patterns. Okay, let me just give you a tip on what we'll be talking about tomorrow. For example, I see, let me give you a clear example. Okay, there's a support here. Market came back and bounced and went up, came back to the same level, and it gave me what? A bullish engulfing. Bullish engulfing at a support is a buy signal. You can see clearly the market went up. Let me give you another example. We'll be talking about this tomorrow, God willing. So I just want to give you, you can also use a trend line if you want. We talk about those trend lines. Here is another case. There's this resistance here, support, resistance. Market comes back, gives you a bearish engulfing, gives you a dark cloud cover, gives you a shooting star at resistance. So you see shooting star, market goes down. Dark cloud cover, market goes down. This is hanging man, market goes down. But hanging man combined with this becomes a bearish engulfing. But before then was a shooting star also and market. So you could trade the shooting star, the hanging man, or a combination of this, and the market goes down. So that's now the value of adding one concept after the other. So we need to talk about support and resistance, or maybe you can cover that today. You want us to cover that?
I think we can.
Okay, so we can combine them, and then we can just add this out to start seeing what's happening. Now, when you talk about support and resistance, this is what we say. When you have a level like this on the chart and another level like that on the chart, if candles are in between, candles are here. Assume these are candles inside here. The level on the market below candles where the market has been bouncing upwards is a support. A price level on the chart above candles where market was changing direction from going up to going down is a resistance. Now, look at it. That is resistance. It resisted the market from going up here, resisted the market from going up here. So it's resistance. This is also resistance. Okay? This is support. Market could not go below. This is support. Market could not go below. This is support. Market could not go below. Instead, it went This is resistance, support, support, resistance, support. So whenever the market is making those movements up and down, like this, these points are resistance. These points are support. If the market was going down like this is resistance, 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 resistance. This is support, support, support. In other words, if you see a market come down and go up, it creates a support. If you see a market go up and then come down, it creates a resistance. All right? Now, what causes this support and resistance to appear on the chart? It is the forces of supply versus demand. You know that if someone is selling goods in the market and there are more people who are willing to buy the item, what does the person do? The person will increase the price. Okay? So whenever there is a lot of demand, if demand is high, and the supply, okay, maybe an illustration, if you have 100 phones you are selling, unfortunately, you have 1,000 people want to buy the phones. This person will hike the price.
Yeah.
Because he knows there are more people wanting the phones. So, in other words, if demand is bigger than or greater than supply, price goes up. If supply is bigger than demand, price goes down. When you look at supply, you think about someone has 1,000 tomatoes, but only 10 people are willing to buy 1 tomato each. What will the person do? The person will have to reduce the price so that more people can go and buy. So whenever you see a market change direction like here, there was supply here. Supply here is bigger than demand. Demand here is greater than supply. Supply greater than demand. Demand greater than supply. Demand greater than supply. Demand greater than supply. Supply greater than demand. You understand the concept now? So we need to draw support and resistance levels on the chart, picking the levels where market change direction. Whenever market change direction, you can be sure there was a demand-supply imbalance at that level. So let's try to pick those points and draw lines. I can see this was a resistance. I can see this was a support. I can see this was a support. I can see this was a support. I can see there was resistance here. I can see there was support here. So that's how you end up drawing your support and resistance on the chart. Just identify areas where the market is changing direction. Support, you draw a line, you draw a line, you draw a line. Now, there are ways of drawing support and resistance. One good way of drawing support and resistance that you can use to trade is you first change your chart your candlestick charts to a line chart. Change from candles to a line here. Here. Remember, we have a bar chart, we have a candlestick chart, and we have a line chart. So if you change to a line chart, all you need to do is identify curves where the market makes a sharp turn. For example, that will be a point. This will be a point. That will be a point. This will be a point. That will be a point. All right? I don't want to identify all of them, but let's first, so you use those where the market makes special curves. After that, then you can turn back to a candlestick chart. Do they look nice? Do they look like they are correct levels? So what you need to do is, after you have drawn them using a line chart, ideally, you now need to start drawing better levels, strong support and resistance. Now, a strong support and resistance will have these characteristics. Strong levels, strong support and resistance levels. Number one, multiple reversals. If you see a point on your chart where the market has reversed from several times, That's a good level. Number two, you must see multiple rejections. Candles forming wicks whenever they come to that point. Multiple rejections. Okay? So if you have a support level, whenever candles are coming to support level, they form a wick, a lower wick, a lower wick. Those are rejections. Number three, must have worked as both support and resistance before. A good level would be one that has worked as support before and has also worked as resistance before. Number four, strong levels are swing highs or swing lows. Swing highs or swing lows. Number five, rapid move away from the levels. A level where whenever market goes to that level, it changes direction very fast and goes away from the same direction. Or you can say 6, covers a long distance from that level. You can say price covers a long distance from that level. So keep these points in mind, and I want to demonstrate what they are. Okay? So number one, you want to look at a point where market has reversed from several times. For example, here, look at this. There was a curve here, there was a curve here, there was a curve here, there was a curve here. In other words, whenever market comes to this level, it changes direction, comes, changes direction, comes, changes direction. You can draw a level there. So if I change to a candlestick chart, you can see market tried to go up, came down, up, down on the same. Now with a candlestick, then you can change it to that. That's fine tuning it. So you use the higher. Now let us also see another point where candles are making a turn. Look at that level here. Look at this level. Somewhere in between. Touched, reversed, touched, reversed, touched, reversed, touched. So this one is acting as resistance, 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 but here as support. Because market was coming down. If you try to go, you can see it looking like that clearly. Resistance, 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 support, support. Now, the other point we were saying is a good support and resistance level can also be a swing high. A swing high is the highest price you see on the chart. The highest you can see on the chart. Like now, if we were here, this is a swing high, the one we are interested in. The highest price on that chart. And a swing low, the lowest price is down here. That also serves as support and resistance here. Support, here as resistance. Now, we are also saying a good support and resistance is when a market comes to that level, it goes away from that level for long. So market comes here, forms your support, and then goes away. For too long, it has not come back to the same level. So that is a very strong level. If the market comes to that level in future, you can trade. You can place a trade. Similarly, look at this level. After this resistance was formed here, market went all those many candles. So it's a good level. But now, this level is not so strong because look at it, formed here, immediately candles come back to the same. So this is not a very strong level. Because price did not go far away from it, number one, and price came back to the level very soon, very soon. What we want is a level where, like now, if I pick this level would be important support. Why? After this level was formed, market has not come back to it. It's a strong market level. This one is also a strong level somehow, because at least the market was able to stay down for so long before coming back to the same level. But those that form quickly and are like now here, look at that. Minor support, just 2 candles up, market goes down. So this is not a very strong support level. This is a very weak level. But One like this is strong because it formed here. No candle has come back to the level for long. Okay. Now, if you see a level where market moves very fast, I mean, you see long candles forming out of it. Look at this level. Market was going up, stopped here, and see 2 candles only. Market went that distance. That's a strong level also. Let me give you another example. Here, market was coming down. From this point, you see only 3 candles, but look at the distance covered by 3 candles only. The same distance was covered by how many candles? Look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 20 candles. But has been covered only by 3. A level like this is very strong. In the future, the market will react to that level if price comes back to that level. I don't think it has come to that level. So those are the things you use to qualify that our support is strong or it's weak. Now, something very important, very, very important that will save you a lot of struggles. When you draw your support and resistance, try to ensure that it has a lot of those features we have already mentioned. Number one, I can draw this. Why? This is the high price on this chart. It's a swing high. I will draw this. It's also a swing low. Swing high, swing low. But what else will give me confidence this level will work in the future? The market has not returned to that level for very long. The market has not come back to this level for very long. The distance covered from that level is big. The distance covered from here is also big. Now let's see whether this level has acted as support and resistance before. That's how you qualify your levels. And whether this level has acted as support and resistance before. So we move back. This one has acted as support before. That gives it strength. That means that level is respected by the market. You can fine tune it a little bit, just adjust it a little bit. Something like that. So that now it's clear support in all cases. Okay? Support, support, support. Let's see whether it has acted as resistance before. No, it's just support, support, support. In the past, it'll be too far. What about the other level? We drew it here. I think we drew it from, where did we draw it from? I've zoomed the chart, now it's misbehaving. I think we drew it from here. In the future, it was used immediately, was respected in future. But in the past, can we be able to see whether it was used as resistance? And we don't have to kill ourselves with that. We can just draw new levels and see whether they work as we are explaining.
And now when you're doing the support and resistance,
yes.
How far would you check the history?
To me, just go back a few candles or zoom like this and test within that distance. I don't like going too far behind. I just need to go and confirm it worked in one case or not. I'll show you. So for example, I believe that this is a strong support.
Assume we are drawing today. Today is 18.
That's the one you have drawn. Okay, let's say, let me go to the 15-minute chart. A 15-minute chart. And I look at the chart and I want to draw support and resistance. And I think this is a nice resistance because market was able to go down some distance. But I want to verify whether it's a level I can trust. So I go back and I just want to see whether it was what was ever used. Yes, when I go back, I realize, okay, here it acted as resistance, not nicely respected. It's not a nice level. I don't want to see a line between many candles. So I'm not comfortable with that level. Then I try another level. Maybe I say, this is support. I want to see whether I can use it in future. Go back. Oh, support again, support. Now it's even used as resistance. Support, 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 resistance, resistance. And if you go here, you realize it was also used as support, as support, as support, as support, as resistance. That's a nice level. Now remember, we are not supposed to be using single lines. We are supposed to use zones. They are called support and resistance zones. So I like drawing a zone. For example, that line is there. The next line will be somewhere here. so that I cover the bodies and the wicks like that. So I draw it from the body and to the tail here. Then I try to see, yes, support here, support here, support here, resistance here. When I go to the past, yes, resistance, some false breakouts, support, support. So that's a strong level. The market will be able to respect it in the future. It's a zone. Now let's see another level. Maybe I want to draw this one. I feel like this level is good. So I want to validate that it's a strong support. I can use it in the future. So I do it from the body to the wick, and I verify in the past. Yeah, you see, resistance, resistance. You can adjust it a little bit so that candles are contained inside. Resistance. It acts as resistance, resistance, resistance before. Resistance, that's a nice level. So you can keep it on your chart. So that's how you end up validating levels once you draw. Now, I will give you another way of drawing support and resistance. You use fractals. Insert, indicators, Bill Williams, fractals. Insert, indicators, Bill Williams, fractals. Oh, you follow the procedure. So add those dots you are seeing on the chart. Okay? I guess you have seen this before. So all you need to do is look for where these lines are horizontal together, close to one another, and they are almost flat. For example, if I look at this and this and this are very close, this and this. So I can draw a line there. And when I look at this and this, they are horizontal, this and this. So I can add a level there. When I look at these two, they are at the same level. Actually, I can draw at the body. Even this one, I could draw at the body, not at the wicks. The bodies are very important. I'm not saying the wicks are not important, but the bodies are very important. Now, we just try to see which ones are very close to one another in terms of being horizontal. This and this, you could draw a line like that at the body. For this and this, they are almost perfect, these ones. So just draw it at that level, okay? For down here, this and this are very flat, same level. You can draw a line there. And you see, you just drop a line based on these fractals, but you see the way it works as support in the future. Now look at these ones. The three are almost at the same level. Drop a line there. And you see it even works very well as resistance before and can be used in the future. So those are shortcut ways of drawing support and resistance also. You can use that. But most people will tell you, if you want good levels, always switch. For example, you go to the 4-hour time frame, switch to a line chart, okay? Look for levels with multiple touches. So I believe those are multiple touches, touch, touch, touch. Look for another level with multiple touches somewhere, like at the top here. Touch, touch, touch. So you can draw there. Here, touch, 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 touch. This is, I will tell you, is a better way of drawing support and resistance. Let's go back. You look for multiple touches only. That's what you are interested in here. You can see multiple touches at the top here. Touch, 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 and then touch as support. Then down here, you can drop another line. You can drop another line here. Touch, 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 touch. Now, let's now switch to a line chart. I'm not going to draw all the levels for sure. You can see there are many. Even here, there's a touch as resistance, a touch as support. Here, there is a touch as resistance, touch as resistance, touch as support. So let's switch now to a candlestick chart for fine tuning. Now look at that. Looks like this. So when you switch to this, you fine tune the levels. Now you go here and say, okay, these are the levels I've drawn. They look nice, not bad. But I think the actual level is here at the body, top. You adjust it. This one looks nice, really, but I think I'm much more comfortable having it here. Lowest candle. This one looks good. I can make it move to the candle to contain this candle. So it's nice. What about this one? This one has cut through the candles. I don't like that. Let it move up so that the candles are below the line, the candles are above the line. What about this one? This one looks like it was supposed to be here so that the candles are up below the line. This one looks nice. You can just adjust it a little bit so that it can contain resistance, and support. This one looks near perfect. Just move it slightly below so that the bodies are above the line. This one looks okay. If you thought it was just all lines, you'll be messed up. So in short, you have created nice support and resistance on the 4-hour time frame. Now you can go to 1 hour to trade. You can go down to 1 hour and trade those levels. You'll see how they react. You draw them on 4 hours, you trade on 1 hour. So you see how they react very well. Now let me start telling you what I was telling you from candlestick patterns. Now, market comes back to, let me start from here. Market goes up to a resistance. It gives you a shooting star or a bearish engulfing. Market goes down. Market comes back to this level, gives you hammer, goes up. Oh, sorry, I've moved the line. Market goes up, shooting star goes down. Market goes up to this level, bearish engulfing, doesn't go down much. You're not going to win all trades. Market goes to resistance, gives you hanging man, goes down. Market comes back to support, gives you bullish engulfing, goes up. Market comes back to support, gives you something that looks like a hammer or a piercing line, goes up. It goes to resistance here, gives you a tiny bearish engulfing or an inverted hammer, hanging man actually, goes down. Market goes to resistance, gives you bearish engulfing, goes down. Market goes to support, gives you piercing line, goes up. Resistance, shooting star, goes down. Breaks resistance, comes back. Now you need to understand this concept. Very important. When support is broken, it becomes resistance. So when resistance is broken, it becomes support. So this was resistance. It has been broken by these candles. The candles have gone up. When they come back to the same level, it's no longer resistance, rather it's what? Support. So you can now trade this bullish engulfing. Okay? So let's get more opportunities. Market breaks your support. It's coming down. If it's coming down to a level, the level is support. If it's going up to a level, that level is resistance. So support. Break support, goes back to support, to broken support, which is now resistance. Gives you that bearish engulfing kind of thing. Market goes down. Comes back to the same level, which is now resistance. Shooting star. If you didn't see the shooting star, you saw bearish engulfing. If you didn't see the bearish engulfing, later you saw the dark cloud cover. Market goes down. Breaks resistance, comes back to the same level. Bullish engulfing goes up. Those are signals. Comes back to the same level, gives you piercing line, goes up. Same level, bullish engulfing, goes down a bit, then goes up. Piercing line goes up. Now we are at that resistance as we speak. The market is at resistance. So you can wait for that candle to close to see what signal you have there. So that's how you approach support and resistance. Are we good? Are we okay with support and resistance so far?
Hello?
Are you okay with the drawing support and resistance? Hello?